Drew Pettit is U.S. equity strategist at Citi. He's maintaining his 6,600 year-end target on the S&P 500, which is below where we are now. So, Drew, I guess I'll start there. Then you think things are going to look a little bit more bearish than bullish here as we move into year-end?
Always the beauty of being a strategist on Wall Street, right? Targets are never right. This is why we spend a lot of time on the bull and bear cases. But on 6,600, the way we kind of spin this is fair value for what we see in visible growth if you discount it back to today. Where we're getting proven wrong right now is the current earnings season is actually started off better than we expected heading into the quarter. And on top of that, while we were pretty bullish on our earnings estimate for 2026, we're slowly seeing the consensus numbers creep up to and almost surpassing our outlook for next year. So how you get more bullish from here, at least fundamentally, is growth, and more growth.
Okay. And so then how do you factor in all sorts of macroeconomic pressures like tariffs? We're still hoping to see some negotiations, I suppose, out of these world leaders, but we don't know exactly what we're going to get. There's a lot of discussion about the further bifurcation of the consumer as we head into a very important season for spending. Are you not thinking that the consumer can hold its weight going forward?
So one part of that, the consumer's only, I would say, a partial part of this story because we're in a big investment cycle on the business side. So the S&P 500 just isn't acting and isn't really as aligned with Main Street as it used to be. The second part, on the tariff discussion, you have an offset from the OBBBA. That's very, very important when we think about earnings going forward. And then we also have just structural efficiency gains by very large corporates with quality balance sheets. So again, kind of working off some of the macro pressure. And kind of the third point here, if Main Street slows down but doesn't go into full-on recession and the Fed is cutting, you're really going to get soft landing tailwinds, and that really supports growth. So I think NASDAQ 100 and the Russell 2000 combined over the S&P 500. So it's really barbelling beta at this point because you have two different catalysts here. Main Street not going into recession and the structural growth in large cap growth.
And so you talked a little bit there about the Russell 2000. We touched on the NASDAQ 100. When you're looking at names like the Mag 7 or some of these AI heavy names, expectations into year end.
So look, there is a lot priced in, I would say almost to perfection here on the structural side. So a little bit of choppiness and profit taking on, well, we jokingly say this, just okay is probably not okay when it comes to earnings, is healthy. So a little bit more volatility there, but buying into those pullbacks is really important for the structural growth names. I would say longer term, why we're bullish here, productivity and investment is huge. We actually see the CapEx growth in AI infrastructure coming in at 24-25% for next year, and consensus is probably looking at more like 20% growth. So we think there's tailwinds into next year, with just a lot priced in and some potential volatility and profit taking nearer term.
Okay, so longer term, it does sound like you're still obviously bullish on AI software, the CapEx that it takes to sort of get there and support this growth. So you don't think that we're in some kind of a bubble for some of these tech names?
No, I don't think we're there yet. I think when we think about AI specifically, and we look across kind of our 5 valuation flags, there's only one that concerns us. There is a lot of pressure on structural growth to deliver. When we break down what's actually driving stock values today, normally you get half of that from your current earnings base. That's more like a third today. So again, a lot more pressure on growth to deliver over what the economy and GDP growth can be itself. But on negative earners, not a lot there. We're still spending a lot out of free cash flow. I know circular financing and debt is starting to work into the conversation now, but free cash flow and profitable companies are really the linchpin to the growth story here.